Hey everybody, welcome back to the channel. Continuing on with the series where I have invited, coerced my friends and colleagues to come onto the channel. My friend Rob Kolenc joining us today. Rob is a investment advisor at Raymond James and arguably one of the smartest people I know. Sadly, he just heard that, so I'm never going to live that down. But Rob has a really unique approach to how he does investing. He's very active. He's got something called Profit Lock, which I want to have him talk a little bit about today. And I also want to share how he came from a medical background into investments and then how he came up with Profit Lock. As most of you know, there's kind of two schools of thought, right? Kind of gamble, right? Try to guess the next hottest stock and ride it to the top, or buy and hold and take all the bruises. Rob, what I find interesting is he's come right up the middle and come up with a way to get the growth, but also secure on the downside so that you don't have to ride what I call the vomit comet. So anyway, without further ado, my friend Rob. Rob, welcome to the channel.
Well, thank you, Chris. That was a hell of an intro. I hope I can live up to that. I wish my wife would say stuff like that about me. She doesn't think I'm particularly bright. So let's see if I can live up to this.
Well, maybe what we can do is show her this video and then she'll have some social proof that we all don't think you're the guy that doesn't take the garbage out. Now, getting right into it, Rob, and I know you're fresh from vacation and your time is tight, so I won't take a lot of it. But what I wanted to do is for you to share a little bit of background, because you came from a non-traditional background to come into investing. You know, most investors did a Bachelor of Business Admin or a finance degree or something, and then kind of curved their way in. But talk a little bit about where your career started and then how you transitioned into financial services.
Well, okay. I hope this isn't too boring, but if I was paying more attention, if I was more self-aware when I was young, I wouldn't have made this big sidetrack in my career. It was an interesting sidetrack. It was really satisfying, but I should have gone straight the finance route. So when I was a little kid, our family friend was a commodities trader, and when we come over to visit, I would look at his charts, and there's his gold chart with the point and figure this, and the oil chart and the currency charts, and I got the bug. I was mesmerized. Now, I was a kid. I don't think I was even a teenager. And so I started getting excited about and reading about how to invest and make money with different techniques and stuff. And so that started like teenager, pre-teenager-ish. And the bug and the fascination of investing stayed with me my entire life. In school, I was good at science, and so I ended up doing science in university, and I got the bug literally for microbiology and genetics, and I took that route. At the time, Canada was trying to develop oil in the Arctic. You might remember that. Man, that might be before your time with Dome Petroleum and all those guys up in Tuktoyaktuk and all that stuff. Anyway, and so there was a real push on how do you control oil pollution in the Arctic, because it's really cold, right? So our lab developed bacteria that could eat oil pollution at 0 degrees Celsius. I was totally stoked about that. And I wanted to monetize that. And my professor said, no, we don't do that. We just, do the genetic engineering, and then we leave that to someone else to monetize. So that was sort of the first kink in the armor where I'm like, I might not fit here. And then I was working on a PhD on cancer research. And again, it was molecular biology and genetics. And we're trying to figure out how HPV virus causes cervical cancer. I had to learn a lot of math to do that. So this is where it goes back to investing. So I'm learning all these statistical things and programming and all that stuff to get an edge on what's causing the cancer and how do we beat it. And anyway, it was the crash of '87. I remember it like it was last night. Crash of '87. I'm in the lab. I'm supposed to be working on my Petri dishes with cervical cancer. and instead I'm updating my charts on the stock market and thinking where my entry points are and what I'm going to do and all this stuff. And that night I come home and I say to now my wife, and I'm like, there's something terribly wrong here that I'm doing my charts instead of working on the cancer stuff. And I said to her, look, there's a million people that would want my scholarship and my spot, and I need to unwind this and go into investing. And so that's basically, that's, you know, too long a story. I'm sorry about that, but that's how I got finally back into investing. It's really like, I didn't really have a choice, to be honest with you, right? It just, I muscled my way into a different career that I didn't belong into. And my nature just kept pulling me back to investing. So it's not like I had a choice, but the math that I learned was really helpful. You know, the math is all about finding trends and what's not background noise and all that kind of stuff. And to my surprise and extreme happiness, I found a lot of this math also works in finding trends in stocks and investments. And so that was the beginning, right, of trying to find better ways to invest.
Kind of moving into that and you know, changing it, bringing a different mindset, I guess, than the traditional advisor, right? Traditional advisors don't have that scientific background where you're almost using the scientific method, right? Looking at what works and what doesn't. And it's not as much as finding, you know, what to do, but also what not to do, kind of excluding. You must have been torn. I mean, I want you to talk a little bit about Profit Lock, but you must have been torn because when people come into financial services, they kind of go one of two ways, right? They're going to go the gambler, right? Where let's find the, you know, the next stock and try to ride it like a rocket, or, you know, buy and hold. Let's just use, what's it called? Portfolio, what's it called, Rob? Portfolio?
Modern portfolio theory,
Right.
efficient market hypothesis. They've got a bunch of names for it. But basically the idea is you can't beat buy and hold. So don't beat buy and hold and just hang on for the long run. It's going to, you know, it's what you call the vomit comet. You're going to have this roller coaster in your portfolio. I don't know how old your viewership is, but in 2000, the NASDAQ fell 70%. It just came back a few years ago to break even. Canada had a high in, like our 2008, we just got back to our high in 2008 a few weeks ago. So that's like 12 years, that's the vomit comet, right? So they're saying you can't beat buy and hold investing. But when you do buy and hold investing, you have literally a generational wait to get your money back very often, right? Like Japan, again, this is probably before a lot of your viewers' memory span of investing, but Japan peaked, I think it was 1989. And it's still like 40% below that price, you know? So the thing with buy and hold, I guess we're going to talk about buy and hold investing first. The thing with buy and hold investing is even with the best index that over the last 20 years, which is NASDAQ, you know, that's the major index that has beaten every other buy and hold investment in modern investing time. It had like a 2000 to 2000, it had like a 16-year wait to get back to the 2000 peak. So then you put on your retirement hat. How do you retire people if they might lose 30, 50, 70% of their money, and then they might have to wait 10 or 20 years to get it back? Like, if you're 55, how do you fix that if the portfolio just dropped in half? When a portfolio drops in half, it goes from 100 to 50, to go to 50 to 100, you got to double your money. That's a big job, right? So how do you retire if you're dealing with the vomit comet? That was the challenge.
Well, you know, that's an interesting part that I think a lot of people don't recognize is they think my portfolio went down 30%. And so as soon as it goes up 30%, I'm back to even, but you're not. When you go down 30%, you have to come up 60% in order to be at the same spot. And I don't think people think that. They go, oh, the market's down 30, it's back up 30. You're still not where you were. And I think that math is what most people don't think about.
Yeah, it's a real problem. And if I don't have my calculator with me and I don't memorize these things, but it's roughly like if you're down 10%, you got to get up 12, 13% to be at break even. And the more your portfolio drops, the bigger the difference is to get back to the break even. So people should be extremely sensitive to not losing a ton of money, because and that also goes to the gambler story, which we can talk about later, because the worse the hit, the more ridiculously hard it is to ever get back to where you were before. And if you're close to retirement or in retirement, if you consume your seed stock, your portfolio, just for paying, for utilities and your food and your vacations, it can never grow back. So that lovely retirement plan, which hopefully people have made because they are important, but that lovely retirement plan that said, oh, you're going to make 6% a year for your whole life, and then, save 500 a month, and then you can pull out, 4,000 a month when you're 60. But like, that thing is just it's just throw it out the window. It's useless, right? So that is, to me, that is one of the biggest challenges in our industry, is we're trying to retire people. We're doing this buy and hold strategy, or worse, the gambling strategy. And then something goes wrong.
Something always goes wrong.
And then that retirement plan simply doesn't work. And then what do? It's too late to fix it. All you can say is, oh, I got to keep working, or instead of living on 8,000 a month, I got to live on 4,000 a month, or move in with the kids.
Right. Well, that's why I'm curious about your profit lock system that you've shared with me over the years. Is, as a diehard Seahawks fan, when we won Super Bowl, defense won Super Bowl. Our offense didn't win Super Bowl. Defense won Super Bowl. And people go, well, how the hell does defense win when offense gets up the points? But the benefit is having a strong defense in place ensures that you don't give up points. And I think with your profit lock system, that kind of plays into that. Is, it's not just riding it up, but making sure you're not taking the elevator when it's free falling. You're just stepping off of it and allowing the market to go down. And once it goes down, then you can buy it up on fire sale again. So talk about how profit lock came to be, because I'm smart.
Yeah.
I'm not as smart as you are, especially in this area.
And
when you talk about it, I don't know how the hell you came up with that when there were the drawing dynamics of either gambler or buy and hold. So how did you make the decision to come up with the system? And then how did that system develop? And I know that there's some proprietary stuff in there, but talk through how your mind worked around what it was to do, what its function was.
Okay, well, there's a lot there, and I don't want to bore your viewers. So when you do research, you basically try to read all the literature in your area to sort of get where the best thoughts are and what's working and what's not working. So I did a survey after I realized that, I can't go through this vomit comet stuff anymore with my personal money, or the stress and pain that it causes my clients. I need to find a better way. So I started surveying all the investors and types of investing systems that look like they had an edge over buy and hold, especially with respect to not losing as much, which you and I both agree, like for the Seahawks and for retirement, is like probably the most important thing. So I'm doing this survey, and then trend following as a system, which I can describe to you in a minute, really looked like it had a really big edge over buy and hold, growth investing. Growth investing is buying companies that are growing really well, like Apple, for example, right?
Is that, sorry to interrupt, but so is that dividend? Like, are growth stocks the ones that pay a dividend?
No, that's a separate matter. But growth stocks are companies that everybody loves. They love the management. They have bright management. They have great products. They have patents that are going to last a whole bunch of years. Like, let's say a biotech company just has a new COVID vaccine or something, right? Like they're going to print money, right? So those are growth companies, and people buy them even though they might seem really expensive, but it's going to the moon. It's a Tesla, right? So those are growth companies. Value companies are companies that are beaten up. Everybody hates. Your friends think you're an idiot for buying them, right? And then hopefully the market comes to its senses a bunch of years later, and you get a lift out of it, and you took less risk because you already bought them for nothing, right? So those are sort of the basic investment styles, and they all have an edge in certain places, and they also have a disadvantage in certain places. Like value investing used to be the best way to invest, and then it basically stopped working 20 years ago when the central bank started printing more and more money. That's my assumption. It's because of QE and a lot of money printing. Value investing basically stopped working. So I found trend following to have the best risk-adjusted returns from what I was looking for. And what trend following is for your viewers is in anything with humans, we're a herd animal, and we sort of get a group think going on. So for example, in music, a certain song starts to become popular, and then everybody likes it, and soon it becomes uncool. Or in fashion, like when I was a kid, it was I'm going to appear really old here. When I was a kid going to public school, it was all about bell bottoms and platform shoes. And then it went, by the time I was in high school and university, it was zoot suits, skinny ties, and tight shoes and punk rock, right? And then it moved on to other things and other things. But there's this herding mentality in any aspect of humans, and we also have it in investing. So, you get a herd mentality around, say, Tesla stock, or, the darling of the year. And more and more people jump onto the bandwagon because they heard how much money their neighbor made and this and that. And then it all collapses. When the last taxi driver is buying Tesla stock, as an example, there's no one else to buy it. And then it collapses, right? And this is an ongoing thing that we've seen throughout the history of investing. That's what trend following is. So, and it's something that you can pick up through statistical analysis of stocks. So right. we pick stocks that are going up. We don't particularly care what they are. We're not listening to gurus or CNBC or any of that. We just want stocks that are in a strong uptrend. There are statistical proprietary ways to figure out if a stock is in a strong uptrend. I'm happy to share more with you if you think your viewers would find that interesting. And then when they start to flatten out or go into a downtrend, you need to leave them, right? And so your portfolio is always changing. It's always picking stocks that are in an uptrend, and it's disposing of stocks that are starting to go down. Well, doesn't that sound like you're protecting your capital? And also what's happening is, as the world is changing, your portfolio is changing, because what used to work pre-COVID, during COVID, all that happened is there's different companies that are doing better, so the tech company that helps you work at home better, Zoom or whatever, I mean, that's doing great right now. And all the kids are buying more gaming stuff to play at home, and they can't keep enough supply of fitness equipment in the stores, right? So all that's happened is different companies are having a great time right now. And, if you're a car rental company or a cruise ship, you're really hurting. But if you're a trend follower, you've already punted that stuff because it's not in an uptrend, right? So it's a good way to get better risk-adjusted returns, and it's a good way to fight a market crash. It doesn't guarantee that you're not going to get drawdowns, but you're likely going to get a lot less drawdowns and a faster recovery, because unlike a buy and hold person, where you're holding, let's say you're holding the Toronto Stock Exchange Index, right? Has a ton of oil companies. Oil went to like minus numbers for a few days.
Yeah, minus 45 or something, wasn't it? Minus 45 a barrel. It was nuts.
It's insane, right? It's got a ton of banks. Banks can't really make money at zero interest rates with a whole bunch of people defaulting on mortgages, right? So that's a huge part of the Toronto Stock Exchange. But if you're a trend follower, you keep the stuff that's working right now. So, right now at this moment, gold and gold mining is working, and technology is working, and a whole bunch of other things are working. And you automatically just shift it to what's working and dump the stuff that isn't working. You don't get that with buy and hold. So that's I
Right.
really, that's why I like it. I need to do that for myself, for my peace of mind. And then I invite my clients to join me. They don't have to. We do all the vanilla stuff as well if that's what they want. But that's what I do with my money, and it's because I don't want to do the vomit comet thing. I don't have the temperament for it.
Well, it must seem too that when a client is more mature, see a 20, 30-year-old, I mean, we'll watch these people that are rolling the dice right now, and what they've said in some publications is that they're replacing their love of casinos and online gambling with sports and going into the stock market and doing their bets there, right? They're going for that, going for the next big thing. I would assume though that when people get into their, mid 30s, 40s, 50s, when they start, amassing huge amounts of capital, if they're doing well, that would be the time for them really to be mindful of the defensive position kind of required. And I think, the traditional model again is, maybe you're 70, 30, 60, 40 equities to bonds and so on. But if I'm understanding it correctly, even the people that were exposed 50-50 during the crashes, like they get murdered. And so the whole difference is, do you want to lose an arm or a finger? And it sounds like with the profit lock, yeah, you might take a hit, but you're going to lose a tip. You're not going to lose the arm. It'll take a long time for that arm to grow back. And so given that you shared that story of looking at the two and then going into the trends, when did you start to develop Profit Lock, and how has that evolved over time?
Oh, that's a great question. So I started, just doing it by myself and making some progress. The difficulty was, there's a lot of literature on how to do trend following and stop losses and a whole bunch of other stuff that maybe some of your viewership isn't familiar with. But I didn't have a way to test it. It's really hard to test these ideas, and people put out, you should use a 5% stop loss or a 10% stop loss. Well, finally, I got a wonderful mentor, two wonderful mentors, and they helped me source a database of all stock prices going back to the 1920s, and a computer system that you could actually test these ideas for what actually works and what doesn't work. And this was a game changer, right? So I want to do a shout out to Tom Basso. He's, for my money, he's one of the greatest hedge fund managers of all time. He was famous for smooth, steady returns, which is what I'm interested in. So it wasn't like I made 80%, I lost 70%, just steady, beautiful returns. And his buddy, Lawrence Bensdorf, who is he's helped me with so much research. So when you have all the stock prices going back decades, and then you can test, for example, stop losses, the literature says 5 to 10% stop losses is the best way to tell if a stock should be punted. And when I back tested, that was way too tight. It needs to be more around 18, 20, 22, 25%. Makes a huge difference in performance and drawdowns. Completely counterintuitive. Couldn't have figured it out without this massive database and a huge honking computer that runs for a week at a time for a test. So, that and a whole bunch of other kind of tests is how I got there. And I did it with mentorship. So that's something that, your whole career is about mentorship, right? If you want to be great at something, it's important to get a coach because that keeps you out of the weeds, right? So I was fortunate enough to get two wonderful, great minds in this industry to coach me and to mentor me.
It's not like you consumed their information, but you actually engaged with those two guys. Like you have a relationship you learned right from the fountain.
Yeah. And I'm very honored about that. And they really helped me bring this to Canada. So, Canada is a different market than the States, and we have different regulations and challenges. And I needed to modify a lot of this research and figure out how do I make this work in Canada. It's, you know, I've got US dollar accounts and that, but for, you know, for Canada, like for a RSP or a TFSA, there's all kinds of different hurdles and things I needed to figure out. So that took a really long time. But it's done now, and now I can sit back and enjoy. And I'm still, you know, trying to fine tune it and give it a better edge and stuff. But the heavy lifting's been done.
So it's almost like having that samurai sword is, even when the sword is done, you're continuing to sharpen it just to keep the edge, because as market shifts, so too, I guess you have to make micro adjustments given new dynamics, especially the COVID. I mean, who saw this coming, right? I mean, you and I have both been talking for years of it's time for a market correction. Where is it? Because you've said, how many times will the average person see a market correction like 2000 or 2008? Did you say 6 or 7?
Oh no, it's going to be way more than that. I'm trying to remember. It's like 16. So like if you go back to the early 20s and count to now, they're like 5 years apart type of thing. So the average person, okay, well, let's just look at the last few years. We had the 2000 tech wreck, we had the 2008 crash, and then we had 2018 was pretty nasty, but then we had this one. This one was a big one. So we've had 3 to 4 since 2000, right?
And so that's what you're saying is the chances of getting your arm cut off are not once or twice. It's not like a shark attack. It's more likely how often are you going to trip. And so 16 times, if that's timed at a poor time, you're 55, 60, you're getting ready to retire, and then immediately you see 30, 40% of your portfolio get vacuumed, you're either going to retire 30% less comfortably, or you're going to work 30% longer just to try to feather your nest a little bit more. It's a pretty expensive correction.
Yeah, and you know, that reminds me of a story. I was working at a different firm during the crash of '08. It was a bank, and they brought us all in. There's probably 60 or 80 brokers in this big boardroom, right? And so it's upper management, and they're going, and it's the crash of '08 and the subprime debt and all this stuff, and they're saying, just tell your clients it's a once in a lifetime event. You're never going to see this again. Who could have known? Hang in. You're in it for the long run. If you liked it at, you know, 100, you got to love it at 60 or 50, right? And I'm sitting there in that room, and I'm like, how is this a once in a lifetime thing? Because I remember 2000 and 97 and the 73 oil crisis. And again, I'm sounding really old, but like this happens a lot. And then I looked it up, and they're like, yeah, these big catastrophic events happen like every 4 to 8 years. So it's a normal part of investing. And this is what really bugs me about the buy and holders. It is a completely normal part of of investing and the marketplace to have really severe market crashes every bunch of years, let's say every 5, 6 years. And we all treat it like it's not normal, it's once in a lifetime. And the best way to deal with it is to just suck it up and behave yourself and pay your fees. Well, you know, I don't I don't think it's correct. And I think you at least got to fight it instead of be passive and say it's all I can do.
Well, and you know, like in the recent news in Canada, what did they say? That Canadians' debt is 200% of their earnings. And so not only do we not learn that this is happening on a regular basis, but we don't even learn the behaviors required to keep ourselves out of trouble, you know, as evidence of, you know, a lot of people don't have a month of money set aside to cover rent or food or so on. And so it's that behavioral thing. And my assumption would be that Profit Lock takes the emotion out of it. And that's kind of what I like about it is, you know, we're having a great year. These markets are great for our business, but we're not listening to what the media is saying. We're not tracking, you know, what the talking heads say. We're just looking at what the data is, you know, new clients coming in, clients that might, like corporate clients that might be adjusting their training budgets. We're not emotional to, will there be a cure or not be a cure? Will there be a new president or the existing president? Will the Liberals become a majority or a minority? We're just looking at the data and making our decisions and silencing the market. And my assumption from what you're saying is Profit Lock does the same thing. Is it's not trying to find the popular kid. It's just looking at the trends and going, this is what the system says to do, even if it's sometimes counterintuitive to traditional philosophy. This is the time to buy, this is the time to sell. And you must have, I mean, we're gonna put you on the hot seat here. You must have had to make decisions during this that didn't make sense, that the system said, we're good. It's like, you know, a GPS saying, you know, there's a turn ahead, I don't see the turn, and then immediately come up to it. So have you had some of those situations where you're like, what the hell is the data telling me to do? And then you just trust the system?
Yeah, so yeah, I'm gonna open up my soul here. This is gonna be embarrassing. But I think the reason trend following works is because it's almost impossible for normal people to do. You're actually being it's called trend following, but you're being a contrarian. Because here's what you need to do. You need to buy a stock once it's already gone up a lot, right? Who wants to buy a stock once it's already gone up a lot? It's really hard to do. You feel like you're an idiot or it's about to fall, right? And then you need to sell the stock once it's already been going down, right? And most people instinct is, well, I'm just going to hold on till it's back up to where it was before or something like that. It is super, super hard to do. And then you have this other issue of there are a whole bunch of gurus on TV and in the newspaper telling you what they think, and you know, they have a nice logical argument. You can get sucked into it, right? So you can get sucked into the drama of COVID and that it's the end of the world, which is easy for me to do because I hate losses, right? So I'm pre-programmed to be kind of negative and worried about things. So just a story about this COVID and how the system pulled us out and put us back in. So when did this start? This is like February or so, mid-February, that the market started to fall, somewhere around there. So the markets start falling. And in trend following, you don't jump off right away. You want to know, because if you take a great stock, like let's say Apple, it bounces a lot, right? So if you get out at the first sign of weakness, you probably got, we call it whipsawed. You probably got out when you're not supposed to, and then it keeps going up, right? So that's why you tend to use a bigger stop loss. But so the market has to fall a reasonable amount before you start cashing out and hitting your stop losses. So it's starting to tell me to sell this stock and that stock, and it's accelerating like more stocks every day. And I am like so upset. I'm so nervous. I'm like, I'm going to sell all these darn stocks, and then the market's going to turn around on me. I'm going to have to buy them back at a higher price. And I was like, as I'm putting in the sell orders, I promised myself I would stick to the discipline. And, you know, we went back and we tested these rules going back decades, right? And I said, I've got to stick to the discipline. So I'm sticking to the discipline. I'm selling these stocks that I love. And I have this, like, I am
on the verge of vomiting in my garbage can at my office. Like I have so much stress, so much anxiety.
And I'm doing this and I'm going to cash, right? And really, I don't think, like, I couldn't have done it without the trading system and having done the research myself, to have the confidence to do it despite every instinct, you know, saying that I shouldn't do this or that it's dangerous. And then when it was time to come back in, I'm starting to get buy signals. And it looks like we're heading into a depression, right? With the unemployment rate and the economy collapsing, what is it, like 30%? Like that, these are all kind of depression definitions. And it's starting to buy stocks every day. And again, I find myself reaching for the garbage pail next to my desk because I want to puke. I'm so stressed about buying stuff, and it looks like we're on the cusp of, you know, the greatest collapse in the economy. And it was right, you know. So it's trend following, I think, works because it's really hard to do emotionally, and that's why it works. I'm pretty sure that's why it works. So you're contrarian even though you're following trends. It's kind of weird, right? It's very easy to fall into the trap of, I guess this is something you talked about earlier. You were talking about the gambler, right? So you have the buy and holder, we talked about that, what I don't personally agree with that methodology. And then you have the gambler. So on the gambler, what you have is a hot stock tip or a great idea. You heard some guru on TV saying that XYZ pharma company is going to be the first one out with a COVID vaccine or whatever. And so you buy some of that. And then you end up, after a period of time, with a portfolio full of garbage that doesn't make any sense, doesn't talk to itself, it's not balanced in any way. And you just have a whole bunch of really well-told stories that you bought, right? And so that, thankfully there's less of that. Well, maybe with the next generation, everyone on Robinhood doing this crazy stuff, maybe we got a new crop of gamblers, but that is usually a disaster. Like those people usually lose most of their money in quite short order. And so like I see investors evolve over time. They usually start as the gambler. That's what gets them interested in this and, making money quickly. They get the living snot beat out of them a few times. Then they become a little bit more careful. And by the time they hit their 50s, they're ready for a guy like me. Like they're ready to not be greedy. Let's not lose a lot of money. We're in the, let's get you some steady growth and make sure that your retirement is beautiful, right? So, but I haven't found, like, people need to go through the process of losing money before their minds are open to, there are better ways to do this.
Well, I'm getting tired of getting beat up, right? Like the reason why people go to judo or jujitsu is they're tired of getting their ass kicked. And they're like, I guess I better figure out how to defend myself. And so it sounds like this is the financial version of jujitsu.
Yeah. And so there were a couple other things that you mentioned earlier that I thought would be fun to discuss. And so let me just put them out here so that if I forget, maybe you can pull me back to it. So one of them was, you were talking about bonds and a traditional, 60% stock, 40% bond portfolio to kind of move into retirement on. So I'd like to go to that. And the other thing that we were talking about, don't remember exactly how we were getting there, but how do you succeed as an investor? And there are kind of three parts. You definitely need a financial plan or a retirement plan, and a lot of people still don't have them, and everybody does them, so there's really no excuse, right? Like in the investment business, it's like the free toaster. We'll give you a financial plan, and it really will help you figure out when you can retire and how much you can save. It's not perfect. And again, if you have a big market crashing, if you're a buy and holder, you're going to have to adjust it. But that's an important module to being a winner in investing. The second thing is, how do you invest? So that's what we've been mainly talking about. The profit lock system that I'm the most comfortable with. And then the third thing that nobody talks about is savings, right? Your savings rate. That is probably the most important one. And people really don't give it anything more than lip service. So your savings rate really drives the whole thing. It's great if you have an advisor and you're growing at a steady rate of return and you don't have a lot of losses. But if it's an $8,000 portfolio, it really doesn't matter, right? So your savings rate is really critical to you becoming wealthy. And it reminds me of that book, the Atomic Habits book that you recommended to me. Incremental improvement. So if you have difficulty saving, which most people do, just starting with $50 a month, and that you probably won't notice that, or it won't make a difference, and incrementally increasing that so that you become a good saver over time. Like that is one of the crucial things. The other thing I wanted to share with you was about bond portfolios and traditional portfolio design. And just to put this in your viewers' mind, because the world is really changing. So when I started in the business, it was easy to get a retired person a portfolio they could live off, because we could get them GICs or bonds and they're paying 6% or more, right? So if you were a good saver, you built up a nice portfolio, you can live off of the interest, or maybe erode your capital a bit, but you could have a nice retirement and keep it safe. having gone through a bunch of crashes, people were nervous about being in the stock market because it can ruin your retirement. So now the cheese has moved on this one, right? So the most important price in capitalism is the cost of rent. What's the price of renting money? And since about 2000, price discovery in what normal interest rates would be has been suppressed to the point that there really isn't a free market in interest rates. And now interest rates are basically zero. All right. That means everything is mispriced. The price of houses, the price of leasing a car, the price of, everything, right? So, and we've had massive inflation in being able to retire. So when I used to be able to retire a person, let's say with a bit of a CPP OAS and a $1 million portfolio or $500,000 portfolio, mainly in bonds and GICs. Now when rates are 1%, I need like 5 times the size of the portfolio if we're going to keep it safe, right? So there's been massive inflation in how much you need to save to retire. And where was I going with this? Yeah, so with bonds at 0% interest, and if we get inflation back, which we suspect we are at some point here, your bonds are going to get killed. So they're no longer the safe thing that is the backbone of your portfolio. So I would encourage your viewers to think about that, especially if they're getting up, in the 45, 50 and higher. The bond part of the portfolio used to be the safest part. Now it's probably the riskiest part. So keep that in mind. And, once again, why we're being forced into equities. Don't want to be in equities. I'd sooner have a whole bunch of bonds paying 6 or 8% that are, AAA credit rated, but that ship has sailed. So now how do you retire? Well, you're going to have to use equities, but you need a way to protect yourself when the market craps the bed. So that is the problem.
And hence Profit Lock.
Well, that's how and why I got to where I am, because that is my problem too. I want to retire. I don't want to, go through the vomit comet when we have our next, what is the next thing? Maybe a bank starts to collapse in Europe, right? I don't know what the next thing is or when, but I don't want my portfolio to get crushed because of that. So, and I can't really save in GICs and bonds because they're paying basically less than the inflation rate. So I feel my hand is forced to go this way, and I don't mind. I mean, I think it's the best path.
Well, you have a system too, right? That's the difference, is when you have a system to rely on. It's like GPS in the airplane. It's better to have it than to try to fly by window at night.
Yeah.
Okay, well, Rob, as you know, because I know you've seen some of these videos, so I always offer up my guests to answer any questions that may have come from this. So what I'm going to do is, in the comments section below, I'm going to put Rob's information, and you can kind of have a look at it. You can check out his website, but you can also reach out to him if you'd like to hear more about the Profit Lock program. It's something that I think is actually really interesting, hence wanting to get him on the show for a while now. But he'll, if you have questions, just drop him an email. Rob's really good at following up with people. Anyway, Rob has to go, as do I, because it's cottage day, which means that I am leaving the big house for the smaller cottage. I want to thank everybody for watching. If you like this video, consider giving it a thumbs up. Subscribe, not because you necessarily want to know when I do videos, but it helps the logarithm. And logarithm? Algorithm? Doesn't matter. You know what I'm talking about. And if you don't, give it a thumbs down. And so thanks for watching. Gladiators eat first, and we will see you in the next video.